Module 5, Business and Investment Income. In this module, let's dive into the world of business income and deductions. We'll also look at various aspects of income determination relevant to both business people and individuals. When we talk about taxable income for businesses, think of it like measuring the health of a tree. Just as you'd account for the water and nutrients a tree needs to grow, businesses consider the expenses they need to flourish. It's a simple idea. You only pay taxes on the wealth your business actually gains. Now, Congress had this idea that businesses should only be taxed on their net increase in wealth. Makes sense, right? If you're running a business, whether it's a cozy little sole proprietorship or a big C corporation, you're incurring all sorts of costs just to keep the lights on and the wheels turning. The tax code lets you deduct these expenses so that you're not paying taxes on money that you've essentially spent to earn more. For example, imagine you're running a bakery. The flour, sugar, and rent for your bakery space? All deductible. It's like acknowledging the soil and sunshine our tree needs. But here's where it gets a tad tricky. The Internal Revenue Code, specifically Section 162, talks about these deductions. It's a bit broad and, honestly, a little ambiguous. This is where tax practitioners earn their stripes. They need to navigate these rules to figure out what a business can and can't deduct. It's like being a gardening expert knowing exactly how much water and sunlight is just right. Understanding the limits on these deductions is crucial. It's not a free-for-all, there are rules and caps. And then there's the whole thing about accounting periods and methods. Some businesses work on a cash basis, others on accrual. This choice can change how and when you count your income and expenses. So, navigating the world of business taxes is a lot about understanding the delicate balance between income and expenses, and making sure you're only paying taxes on what you really should be. Just like our tree analogy, it's all about ensuring the business has everything it needs to grow, without burdening it with excessive taxes on the resources it used up to get there. Taxes on investments. Venturing into the realm of taxation for individual investors, we find a landscape rich with opportunities and challenges. This journey encompasses the tax rules applicable to various forms of investments, including stocks, bonds, passive investments in flow-through entities, and real estate. It's a world where understanding the nuances of taxation can significantly impact investment decisions and outcomes. In portfolio investments, you'll encounter two primary types of earnings: interest income and dividend income. Interest income, often generated from bonds, is taxed as ordinary income. It's straightforward. You earn interest, and it gets added to your other income, subject to your usual tax rate. Dividend income, however, dances to a different tune. Dividends are classified into two categories: qualified and non-qualified. Qualified dividends, which typically come from shares in U.S. corporations or certain eligible foreign companies, enjoy a lower tax rate akin to long-term capital gains. In contrast, non-qualified dividends are taxed at the standard income tax rates. Capital gains. Now, let's talk about capital assets like stocks. The tax treatment here hinges on gains or losses from their sale. If you sell an asset for more than its purchase price, you realize a capital gain. If less, it's a capital loss. The intriguing part is the netting process. Capital gains and losses are netted against each other to determine the taxable amount. Importantly, long-term gains, on assets held for more than a year, benefit from lower tax rates compared to short-term gains. Capital gains tax, though, applies only if the asset is sold during the applicable year. Consider Sarah, who earned $73,200 from her job. Her stock in ABC Company increased in value by $11,000, but she didn't sell any shares. She also received $40,200 from life insurance proceeds due to her husband's death. For tax purposes, only her compensation, the $73,200, counts as gross income. The unsold stock appreciation and life insurance proceeds aren't considered taxable income. The former because it's unrealized and the latter because life insurance proceeds are specifically excluded from gross income in the Internal Revenue Code. Gross income includes a variety of items like gambling winnings, even illegal income, and cash dividends. However, the face amount of life insurance received due to the death of the insured is not considered gross income. It's one of those unique exceptions in the tax code. Deduction for investment interest expense. Investment interest expense is another critical aspect. This is the interest paid on money borrowed to make investments. The IRS allows investors to deduct this expense, but here's the twist. The deduction is capped at the net investment income, which includes interest and dividends, but excludes qualified dividends. This rule ensures that the deduction for investment interest doesn't exceed the income generated from those investments. In the universe of investment taxation, it's not just about understanding individual rules, it's about seeing how these rules interact and affect overall investment strategy. For instance, savvy investors might hold onto assets longer to benefit from lower long-term capital gains rates or strategically time the sale of assets to optimize the netting of capital gains and losses. Now, let's turn to discussion of some other aspects of taxation relevant to business and investment income. People who own businesses report their business income and deductions on Schedule C of the Form 1040. This form is the way of telling the IRS about the business's financial activity for the year. Compensation and bonuses. Imagine John working at a firm. He gets his regular wages, likely paid hourly, and a fixed salary, perhaps on a monthly basis. Now, if John gets a bonus, that's additional compensation, but here's the interesting part. If his bonus is paid after the end of the year, but within 2.5 months, it might not be counted in his income for the year it was earned. Instead, it could be part of his income for the following year. Income recognition for cash-basis taxpayers. If Nora, a music teacher, receives payment for a one-year contract but only provides part of the service within the year, as a cash-basis taxpayer, she must include the entire payment as income for the year she received it. This is true even if some of the lessons are given in the following year. Constructive receipt of income. The concept of constructive receipt is key in determining when income is taxable. If Tom's employer gives him a paycheck, it counts as income even if he receives it after banking hours. However, if the employer doesn't have sufficient funds to cover the check, it's not considered income yet since Tom hasn't really received anything. Consider a scenario where Jessica exchanges services with someone. For instance, she does their taxes in return for car repairs. This barter is considered income for Jessica. However, receiving a student loan, awards used for tuition, or a cash gift doesn't increase her gross income. Deductions. However, certain benefits like working condition benefits, de minimis benefits, and no additional cost benefits for employees are excluded from gross income. However, disability income from an employer-financed policy is not excluded and must be included in gross income. When it comes to deductions, not everything makes the cut. For example, expenses incurred in gambling activities are not deductible for adjusted gross income, although expenses incurred in a trade or business, production of rent, or royalty income are. Consider the story of Emily, a dedicated elementary school teacher and a part-time real estate investor. Emily, ever careful with her finances, consistently contributes to her retirement plan. Additionally, she incurs various costs for school supplies and maintaining her rental properties. Emily's colleague, Michael, however, faces a different set of circumstances. As an employee at a technology firm, Michael often incurs out-of-pocket expenses for business-related activities. However, the Tax Cuts and Jobs Act of 2017 brought about a significant change. Unlike Emily's retirement plan contributions, classroom expenses, and rental property maintenance costs, Michael's unreimbursed employee business expenses no longer offer any tax relief. This legislative shift meant that such expenses could no longer reduce his adjusted gross income, a stark contrast to Emily's situation. In a different scenario, let's meet Leo, a television anchor conscious of his on-screen appearance. Leo decides to undergo several medical procedures and purchases to maintain his image. His expenditures for the year include $2,000 for his daughter's medical bills. His daughter is claimed as a dependent by Leo's former spouse, $400 for a new pair of glasses, $1,100 for dental procedures, and a substantial $4,500 for cosmetic surgery to address his concerns about aging. Cosmetic surgery costs are generally not deductible unless the procedure is necessary to ameliorate a deformity arising from or directly related to a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. If Leo's facelift was purely for cosmetic reasons and not for medical necessity, it would not be considered a deductible medical expense. So, Leo would then only be able to count $1,500 as qualified medical expenses. When assessing support for a dependent, it's important to consider what counts and what doesn't. Things like food, clothing, and the rental value of lodging are considered support. However, the value of services rendered by the taxpayer for the dependent, like personal care or tutoring, doesn't count as support for this purpose. Filing tax returns and extensions. Let's say Emily needs more time to file her taxes. She can ask for an extension, which doesn't extend her time to pay any due taxes, but does give her more time to file her return without a penalty. If she files an extension, the latest she can submit her return without a failure to file penalty is typically October 15th. It's like getting extra time for a school project, but still needing to meet the final deadline. Consider Alex, who earned $25,500 this year. He had $1,500 withheld for federal income taxes, but will only owe $1,355, meaning he's due a refund. Despite expecting a refund, Alex is still required to file a tax return. It's not just about whether he owes tax, it's about settling up with the government. In our next module, we will turn to taxes on real estate and tax factors relevant to home ownership.